Hello, what's up, everybody? This is Sunko, the Korean bro. Today is 2023, May 21st, and let's read stock related articles, okay? Well, will Pound stock be in 3 years? Should you buy the deep on Airbnb stock? Three super growth stocks down 70% to 88%. You wish you buy on the deep. This dividend stocks can double your money in under 7 years. Take two stocks is up 34%. Is it too late to buy? Hmm. And what else do we have? A bull market is coming. One incredible growth stock to buy hand over fist before it soars. 1,058%. What else do we have? Buying $1,000 of these dividend stocks could supply passive income forever. Um, Amazon stock. Uh, hmm. Okay, let's see. I just picked like 10 articles right now. Pell and the shares are substantially off their all-time high. Mm-hmm. Hmm. Okay. If management can implement a turnaround, investors might be rewarded. Pound is aiming for more users, higher subscription revenue, and a rising stock price. The trouble the fitness innovator is going through a huge strategic shift. It's hard to understate how dramatic Pal Interactive's rise and fall over the past few years has been. By the end of 2020, the stock was up 489% from its price at its initial public offering. But as of this writing, shares are down 96% off of their all-time high. The business went from Wall Street darling to now being in the midst of a major strategic shift. Assuming Pound is able to successfully execute its ongoing turnaround strategy and get the business on a better path, where could the consumer discretionary stock be 3 years from now? Investors could be handsomely rewarded. Here's why that could be the case. Okay, this author seemingly are really interested in buying this stock. Okay, attracting more subscribers. The name of the game for Pound is to find ways to attract more connected fitness subscribers, which are users who own a piece of equipment and pay the monthly membership fee for access to the workout content. As of March 31st, the company had just over 3.1 million of these subscribers, good for a 5% year over year increase. The figure has steadily climbed over the years, even as Paladin's financials have struggled. However, for the current quarter, management expects connected fitness subscribers to post a sequential decline, thanks to the uncertain macroeconomic environment. Because Paladin's products are discretionary in nature, consumers will certainly delay purchasing fitness equipment if times are tough. But CEO Barry McCarthy mentioned how Amazon has been a solid distribution partnership thus far. Selling pellet equipment at Dick's Sporting Goods locations can also work to boost subscriber numbers over time. And by emphasizing the certified pre-owned and rental programs, which increase accessibility while also launching new products and entering new markets, Paladin can find ways to grow its user base. Great dependence on subscription revenue. In each of these three financial quarters of 2023, Paladin subscription revenue has exceeded that of its hardware sales. Mm. And this appears to be McCarthy taking a page out of the playbooks of his former employers, Netflix and Spotify. The benefit is that subscriptions carry a super gross margin of 68%, while hardware sales have produced a negative gross margin for several quarters now. The hope is that as more of Paladin's equipment finds its way into more households, even if the products are sold at a slight loss, the business can make up for this with its high margin subscription fees. Palan's total gross margin in the latest quarter was 36.1%, up from 19.1% in the year ago period. When subscriptions only represented a little over one third of overall revenue, if this continues trending the right direction, the company can once again become fully profitable while generating positive free cash flow. That's something shareholders have been desperately waiting for, pedaling to a higher stock price. More connected fitness subscribers and better margins and profitability are starting to push up pound in stock price in 3 years. Especially since at this point in time, there's so much uncertainty about what will happen to the business. Obviously, better fundamental performance from a company that has been struggling so much will quickly be a boon for a stock. Right now, pound shares trade at a price to sales ratio multiple of under zero point 0.9. This is about as cheap as the stock has been in its entire history. This valuation demonstrates the heightened negative sentiment that has surrounded this company for the past couple of years. More of its clear indicator that shareholders view the success of a turnaround situation as being completely up in the air. Having to go through another product recall this time with the fracture bite is also pressuring pound stock. But if the company can hit the top two goals of growing its subscribers base and improving margins, shares should be higher in 3 years' time. Ultimately, it's up to investors to think about if they're willing to take on the risk. Okay, what about Airbnb? Quarter first was another strong period for Airbnb. Forward guidance caused many investors to sell the stock. Airbnb looks attractive by nearly every valuation method. Looks attractively valued. Okay. There are multiple ways to value a business. You can use its revenue, EPS, or even free cash flow. Each has its flaws, but if a company has a legitimate reason to be valued by using all three metrics, I think examining them all is worthwhile. Uh, from a price to sales standpoint, Airbnb is trading at 8.6 times sales, almost the lowest level in its entire life as a public company. Although that may seem like an expensive valuation for a travel company, Airbnb's margins are more like akin to a software stock. So the industry is much better comparison. With 10 times sales, usually the average in that field, Airbnb stock doesn't look that expensive from that standpoint. Switching to price earnings ratio, Airbnb stock doesn't look as cheap. Even when forward earnings are used, the stock isn't cheap at 30 times earnings. However, we've already covered how often Wall Street has been wrong in predicting Airbnb's earnings, and that the company consistently exceeds expectations. Because of that, I'd say its P&E ratio is reasonable. Finally, price to FCF makes the stock look like a screaming buy. At just 19 times FCF, Airbnb looks attractive. That's a lot of FCF generation for a cheap hit price and is significantly cheaper than other popular investments like Microsoft, Apple's, and Alphabet. Although Airbnb is currently facing some headwinds, it's proven executor in a growing industry. It's proved multiple times that it can exceed expectations, and with the stock trading at a great entry level, I think right now is an excellent time to purchase Airbnb shares. And what are the three Confluent, Digital Ocean, Raffen? Okay, let's see one by one. Okay. Hmm. Confluent data streaming is a technology rapidly growing in importance for business because consumers are increasingly demanding more live experiences from their digital products and services. Confluent is a leader in the industry, and some of the largest companies in the world are flocking to its platform. Cloud computing, all those businesses operate online. And every interaction within their digital ecosystem creates data. The ability to use the information instantly is a game changer for the customer experience. A retailer, for example, can manage inventory in real time so products never go out of stock. And an online sports betting platform can offer live stock. An online sport betting platform can offer live markets during a game because data streaming allows them to calculate odds, feed them to the users, accept bets, all within seconds. The technology has implications for almost every industry. And international data Corp predicts 90% of the world's 1,000 largest companies will be using it by 2025. The first quarter of 2023, Confluent generated $174.3 million in revenue, up 38% year over year, and well above its $168 million forecast. Mm. But there was an even more impressive figure. The number of businesses spending $1 million or more on Confluence platform surged 53%, more than 3 times faster than the company's customer base grew overall. Confluent has significant growth runway ahead because it thinks the data streaming opportunity is worth $6 billion right now, despite 8% gain for its stock in 2023 remains 70% below its all-time high. So it's not too late for investors to buy. And next one we have is Digital Ocean. Well, it's a provider of cloud computing services that all its customers store data, host website, and even develop software. It has one significant point of difference from its major competitors like Amazon Web Services and Microsoft Azure. This is the Ocean targets small to medium-sized business with under 500 employees. It's a lucrative segment of the cloud market because this the Ocean can develop a relationship with business in their startup phase and then reap the financial rewards when they begin to scale up. The company offers personalized service, cheap pricing, and simple cloud platform with a one-click deployment tools designed to suit its target customers. Other cloud providers are more focused on large and enterprise customers, so they don't typically offer a competing value proposition for small businesses. As of quarter first, DigitalOcean had 146,500 customers spending more than $50 per month. That includes 15,000 scalers, which are its top spenders, each contributing on average of $1,962 per month to the Ocean's revenue. Speaking of which, the company generated $165.1 million in revenue during the quarter, marking an increase of 30% year over year. So this Ocean stock price has jumped 36% this year, but it's still down 72% from its all-time high. The company is playing in a $98 billion segment of the cloud industry, which could double by 2026. So investors might want to take advantage of a discounted stock price while they still can. Raffin got off to a strong start in 2023 with the stock price up 149% so far this year. But it's still down 88% from its all-time high. The real estate technology company struggled over the last 18 months because U.S. Federal Reserve embarked on the most aggressive campaign to high interest rates and its history to fight soaring inflation. This is greatly impacting demand for housing because consumers can't afford to borrow as much money, leading to a slowdown in Raffin's business. First, the company was forced to close the Raffin, now a direct buying business, where it purchased homes directly from willing sellers and try to flip them for a profit. It was becoming too risky to haul hundreds of houses in inventory, while home sales were slow and prices were leveling off. Closing the segment was an opportunity for a company to refocus on its core brokering business and chart a path toward profitability. Rafa employs 1,876 lead agents covering 98% of the U.S. housing market, allowing the company to operate at a level of scale that smaller independent retailers can't match. As a result, it charges listing fees as low as 1%, undercutting the more common rate of 2.5% and creating win-win for Raffin and its sellers. Okay, Raffin is a mm, real estate business, and it's governed by. Uh, it's most likely made up with digital. It's digitalized. Okay, and Digital Ocean produces. Well, Confluent produces real-time data streaming, DigitalOcean provides a platform where people can deploy their software and provide services to people worldwide. But then the difference between them and Amazon is that they offer services that can be used by the company under 500 employees. Uh, so if you are running a business, uh, if you're running a small business, it'd be much better for you to just use DigitalOcean than AWS because it can be easily used. Uh, and that's about it. And three dividend stocks that people recommend. Ample Fuel. Take-Two stock has been on tier in 2023 and surged even higher following the recent earnings report. Management expect new releases should drive record bookings and cash flow within the next 2 years. The stock trades at an expensive price earnings ratio. Take-Two Interactive. After sliding last year, what the market sell off, Take-Two Interactive has rebounded 34% so far in 2023. The game maker reported better than expected earnings results for the fiscal 2023 fourth quarter, the Sandy stocks were. A bull market is coming. One incredible growth stock to buy hand over fist before it soars 1,058%, according to Wall Street. Let's see. A struggling advertising market and macroeconomic headwinds have weighed on Roku stock. Even in the face of the worst slowdown in more than a decade, the company has continued to generate growth. So strong secular tailwinds, industry leading position, the rebounding ad market should help the stock bounce back. The streaming video landscape has been evolving over the past year or so. Slowing guidance growth has some investors fearing the best growth has passed. The evidence suggests, however, that there remains a large untapped opportunity. Okay, let's see Roku. Hmm. The secular decline of cable TV is gathering steam, and cord cutting is actually accelerating. The major paid TV services have lost 5.9 million subscribers in 2022, surpassing the record losses suffered in 2020. According to data compiled by Lithman Research Group, Logic dictates that all these former viewers will seek a new source for their in-home entertainment needs, and streaming video is the logical beneficiary. Hmm. There's more. Streaming video remained the top choice of television viewers in April, accounting for 34% of all TV viewing, now pacing both cable and broadcast TV, according to data compiled to Nelson. Uh, At the same time, broadcast television slumped 3.7% year over year, while cable TV audience declined 12%. The numbers don't lie. Not many companies can go toe to toe with Amazon and win, but Roku is among that seller group. Roku is the most popular streaming device worldwide, with a 23% share of all devices globally, according to Conviva's State of Streaming report. Amazon's Fire TV had roughly half that way 12%. Roku also offers viewers much more choice in terms of streaming channels on its platform than Amazon. Hmm. Roku have nearly 37,000 channels in its app store. Hmm. According to mobile and connected TV app intelligence companies 42 Matters, Amazon's Fire offers only half as many with about 18,000. The data helps illustrate that Roku has inside track in terms of market share and audience appeal, which will help drive its future growth. That Roku has the inside track in terms of market share, long-term opportunity. Okay, when the economy slumps, a company frequently scales back spending on marketing, and this time is no different. The situation has pummeled Roku since the company makes the lion's share of its revenue from the 30% cut off all the advertising shown on its platform. That was front and center in the company's first quarter financial report, as platform revenue, which includes advertising, declined 1% year over year, even as active accounts grew 17% to 71.6 million, and viewing hours of 25.1 billion climbed 20%. This suggests that when the advertising market recovers, which it inevitably will, Roku is poised to rebound. Furthermore, the company's recent move into the connected TV market provides another way for Roku to increase its strong and growing share of the streaming device market. In fact, the Roku operating system is already the top-selling smart TV operating system in U.S. with a 43% market share. It also took the top spot in Mexico for a second consecutive quarter. Wall Street remains bullish on Roku. Like so many technology stocks, Roku has been punished as a result of the economy that even as it continued to grow. Some of Wall Street best and brightest believe the selling has simply gone too so far. According to consensus estimate of 32 analysts covering Roku, the stock has a median price target of $67. This suggests potential gains for investors of 26% over the coming year compared to Roku's current stock price. Furthermore, of those 32 analysts that cover Roku, 27 rated a buy or strong buy, and only one recommends selling, citing the ongoing macro headwinds. However, Art Investment Management CEO Kathy Wood is much more bullish and looking further ahead, suggesting Roku stock will soar 1,058% and hit $605 by 2026. But Ork's bull case is even more eye-catching, suggesting the stock could climb as high as $1,493, surging more than 2,700%. Even if Roku doesn't meet that audacious benchmark, it suggests the potential is there. Currently selling for a song with a price sales ratio of 2, near its lowest valuation ever. I've been bitching the drama for Roku for some time. The company now has a greater audience than all the cable TV providers combined, hmm, but continues to suffer the effects of the challenges in the digital advertising market. Once the ad market rebounds, Roku is well positioned to ride that wave to new heights. That's why I've continued to add my position throughout the downturn. With subscribers abandoning cable at a record pace, a deeply discounted valuation, and rousing endorsement from Wall Street, now seems like a great time to buy Roku stock ahead of the inevitable rebound to come. Bank of America. Why would he buy Bank of America and AT&T? Let's see. Warren Buffett and Berkshire Hathaway, the holding company he's managed since 1965, bought a whopping 22.8 million shares of Bank of America during the first 3 months of 2023. Before you assume this is a Buffett's favorite stock of all time, you should know that New England Asset Management, Berkshire Hathaway subsidiary, trimmed its position, resulting in a net addition of 250,000 shares. Bank of America had to slash its dividend payout during the global financial crisis of 2008, but the payout has risen an impressive 83% over the past 5 years. Now it offers a yield of 3.1%, which is 84% higher than the average dividend paying stock in the benchmark S&P 500 index. Okay. Let's skip and go to next one. Hmm. Okay, what is this one? Built on a very sound foundation, very steady grower. Sales should be much higher than they are today, but Amazon might not get into the top spot. Profitability is pressured right now, and the company is working to improve it. It has made many acquisitions to dominate several industries, including streaming and healthcare. Amazon, bigger, more profitable, more dominant. Where will it stop be? No one can predict any kind of stock movement with certainty. 3 years ago, I don't think anyone would have predicted that today Amazon stock would be below where it was then. However, given current lows and Amazon's efforts to improve efficiency and generate higher sales, I would venture that in 3 years the stock could be way ahead of where it is today. We're still in a bear market and recession could be coming. Hmm. And if we're back in a bull market 3 years from now, expect Amazon stock to be soaring. So in 3 years, he expects that it's more dominant, more profitable, and bigger. Brookfield, Renewable Partners, Enterprise Products Partners, IV. Okay, let's see. But three no-brainer dividend stocks to buy with $1,000 right now. Hmm. Apple, Microsoft, Alphabet, Amazon. Amazon is a perfect mix of variety, growth, and results. Multifaceted revenue stream provides redundancy. A weak economy or competitive pressure might hamper growth in one segment, but the company often gets the last left as a new segment catches fire thanks to a new product innovation. At any rate, it remains one of the largest and best run business out there. And for me, if I could only one buy stock, it would be Amazon. Its large and varied revenue stream provides shareholders with diversity even if they own no other stocks. That's because Amazon is the world's largest e-commerce company, the biggest cloud computing company, operator of one of the largest subscription-based models, a generator of billions of dollars from online advertising. That's to say nothing of other endeavors that Amazon is pursuing, such as smart devices, music and video streaming, and healthcare. This mixture of revenue sources and unrelated units would be invaluable for investor who could only one stock. The second reason this is the best stock to own, if you could only own one stock, is that Amazon's business looks like it's on the upswing. The COVID-19 pandemic was a boon for Amazon. Homebound shoppers loaded up their vital virtual carts, and Amazon's share price skyrocketed. However, the company has been dealing with something of a hangover since the pandemic has waned. High inflation, energy costs, and overstaffing kept a lead on Amazon's share in 2002. Yet this year, the stock is on fire. Shares are up 35% year to date, and the company recently reported excellent first quarter results, highlighted by a total revenue of $127 billion, which topped estimates. Amazon Web Services revenue of $21 billion, up 16% from a year earlier. Advertising revenue of $9.5 billion ahead of expectations of $9.1 billion. What's more, CEO Andy Jassy noted that the company's investment in machine learning continued to pay off. Our advertising business continues to deliver robust growth, largely due to our ongoing machine learning investments that help customers see relevant information when they engage with us, which in turn delivers unusually strong results for brands. Okay, that's about it for today. And I must see you tomorrow, okay? Bye bye, everybody. Have a good night.